Moving swiftly along. So into the next one. At the beginning of 2012, Google was priced at $8.50 and 11 cents. Google's beta is 1.15, and the risk-free rate at the time was 10%, with a market portfolio risk premium of 6%. Google's price at the beginning of 2013 was $755.69. So use this information to answer the question of what was the actual return, the required return, and did Google exceed investor required returns. So first off, we can start off with what was the actual return for Google. So starting off with the actual return, that will be at the beginning of 2012, it was priced at $5.80. So I always remember that at the beginning of 2012, $5.80. So you always use that beginning one twice, and so you always use the before year twice, and so you'll start with the 2013 year, so it's 569 minus that 580.11, and like I said, you'll use that twice, so you'll divide it to see your return. And so this takes at 755 minus the 580, which is 170, somewhere in the 170s, and then divides it, and that gets you your return, which is equal to 30.27%. And so the actual return was that 30%. It was 580 a year ago, 755 now, and so what's the difference between those? That 30%. So now let's hop into the next question. I'll leave up the answer right there. What is the required return? So the required return, like we said, is that market risk premium of what investors expect to receive above the beta because of the risk that they're taking on. And so what comes with that is the CAPM formula. So the required return equals your risk-free rate was 0.1, so 0.1 plus your, Google's beta is 1.15, so plus 1.15 times the market portfolio risk premium, which is 6%, times that 6%, which is equal to 7%. And that is the required return that investors need to invest in this stock, put up their capital, and what they essentially need to take on the risk of owning Google stock. And then, did Google exceed investor required returns? So because they returned 30%, investors only needed 7%. They more than quadrupled it, so the answer to that one is yes. Yes, they did. Moving along, a stock is priced today at $12.50. Analysts have a consensus view that the stock will be valued at $15 next year. The stock will not pay a dividend in the coming year, and after a little research, you know that the stock has a beta of 1.2. The risk-free rate in the economy is 4%, while the market risk premium is 6%. So if CAPM and the analysts are correct, what price should the stock be trading at today? And so jumping into the solution and how you should think about this problem. So for a stock to be in equilibrium, the actual return expected by investors should equal the investment's required return found in the CAPM formula. So what that actually means is, what is our expected return? Remember, we just did this with Google. So the stock will be valued at $15, so 15, and today it's $12.50. So minus that $12.50, you'll use that twice because it's in the past, and that equals 20%. So investors will be expecting 20% from the analysis and what they think the stock will be valued at. Now we need a required return. Like we went over, what that required return is what investors need to invest. So the required return is that CAPM formula. That is what the cost of equity, the cost that the company will have to pay for investors to invest in this company. So we start off with 4%, which is the risk-free rate, plus your beta of 1.2, find that there, multiplied by the market risk premium, which is 6%. And if you put that in your calculator, it leads us to 11.2%. Let's get the rest of this off our screen. And then we will be moving into the next part. So we'll leave those two up. Those are our two answers. 20% and 11.2% from the expected return and the CAPM formula. So now we can solve for the price. And so the price formula, the price at P0 right now, equals the price at P1, which is 1 year out, which is this, over 1 plus your R, which is your required rate. So P1 is 15, so 15 over 1 plus 0.1120. So if you put that into your calculator, that leaves you with 13.49 as your final answer. And so this is the price that the stock should be trading at today. But since the stock is trading at $12.50, this means that the stock is undervalued and that you should buy it, because if the predictions come true of what you actually think the stock should be valued at, then the stock is trading undervalued right now, and there's potential for it to grow and for you to make money on your investment. Moving into the next one, which is a little bit similar. So a stock is priced at $15 today, and analysts have a view that the stock will trade at $18 in 1 year. The current risk-free rate in the economy is 5%, while the market portfolio risk premium is 7.5%. If the stock is fairly priced today, what is the implied beta for the stock? So this is very similar to what we just did. We first find expected return, which is that what is going to be in the future. So it's going to trade at $18 in 1 year. So 18 minus what's it trading at in the past or today is at 15, and you'll use that 15 twice. And that equals your 20% if you put that into a calculator. So that's the expected return of what you could see, what an analyst or someone that came up with a valuation expects the stock to return over the next year. Now, the required return is the CAPM formula that we've been using this whole time. So that is your 5%. The current risk-free rate in the economy is 5%, plus your beta, which we're solving for, multiplied by, 7.5% market risk premium. So this means that we have to solve for the beta, but lucky for us, we solved for the expected return. So that means we subtract 5%. Actually, let me go through and do it on another little piece over here. So we have 5% plus our beta times 7.5 equals 20. So first you minus 5, beta times 7.5 equals 15, divide by 7.5, divide by 7.5. That means your beta is equal to 2. Good job. So I think this is the last one. Yes, it is. We're moving our way through the CAPM formulas. So finally, these tend to be pretty tedious, a lot of work, and you normally get a couple questions about these on tests or homeworks or whatever, but they're all pretty similar, and so I was only going to do one because it's not difficult. It's just very tedious, and in a second you'll see why. So an investor has $10,000 to invest in 5 different stocks. Information regarding the 5 stocks is shown in the table below. So what is the beta for this portfolio? So looking for the beta, which is similar to what we just did in the question up here. And so the solution, if we get into how to solve this, the beta is of the portfolio is the weighted average of each beta in the portfolio. And so there's a whole equation written out for it. I wrote it down so I can copy it. The beta of the portfolio equals the weighted average, the beta of that average plus of B, beta B, and then it just keeps going however many there are. And so what this means is, let me scroll down a little bit. Actually, wait, so we can still see that. There we go. So that means WA is equal to the total invested in stock A over the total invested in the portfolio. Because it's a weight, we want to see how much it's weighted. We have to look at how much we invested in this stock versus how much we invested in everything to see the total weight. So if we look at stock A, we invested $1,500. And then the total weight is $10,000. We invested $10,000. So that equals 15%. And then if you go down and you do that for all of them, you will get, let me scroll down a little bit more. If you go down and do that for all of them, you'll get 15%, just because I don't want to do all of it. 25%, 30%, 10%, and 20%. So that's all 5. And so what that means is that you then multiply that multiplied by your beta, because you're trying to find the beta of the entire portfolio. So this is the beta. So you multiply the weight by the beta. So the first one's weight is 15%, so that's 0.15, and the beta is 1. So times 1. You do that for all of them. So plus 0.25 times 1.2 plus 0.3 times 0.7 plus 0.1 times 0.9 and plus 0.2 times 1.4. Imagine that is up there. And if you put all of those together, that is 1.03 for the weighted beta for the entire portfolio. So that's all the problems that I have. Today, we'll be going over a couple more. I plan to come out with a couple more videos and tutorials. If anything could be made more clear, or you want to go over something, I'd love to. But when it comes to CAPM, just remembering what each thing means, what the beta means, what the current risk-free rate, the market portfolio, and how to find them. But really understanding what they are will help you kind of put together the pieces of where to plug them in. And so by studying that and knowing some of these formulas like expected returns and where to plug different things in, it's a very fun concept, and it can be pretty fun to apply to the real world and how we use analysis and valuations for stock prices in the future as well as today. So thank you so much for watching, and I hope you come back for the next one.